Speaking of which, folks, yesterday a lot of viewers reached out and said they were shocked to learn that names like Apple and Amazon are components of the S&P Value ETF. Not only the components, it's the number one component by far. Apple almost 7%, and Amazon number 2 by far. This is amazing. Now, my next guest is considered among the best value investors on the street. I want to bring in our Portfolio Wealth Advisors President and CIO, Lee Munson. And Lee, it seems that I just had this conversation with Lance here, and we talked about it yesterday. The term value has become nebulous. It means different things to different people. What's your definition?
I go the old school Warren Buffett thing. You're looking for companies that are out of favor. They're mature. They might be companies that we know. They might be a staple. They might be technology. It could be any sector, but they are not in favor right now. They're trading at a multiple that seems a little low versus their current growth prospects and going forward. But you have to believe that the companies will continue to improve or those earnings will accelerate, or you get a value trap, which is basically like a chemical company that's always going to trade at a 5 multiple.
All right, so let me ask you about staples, right? So this is a great chart from Ned Davis. You got the S&P Staples Index. You can see it broke out. It looks absolutely phenomenal. And these are your forward PE. This also is the highest. This is the highest maybe it's ever been. Certainly it's been in 30, 40 years. So it's a sector that's always associated with being inexpensive. But again, on an absolute basis, it's never been this expensive. How do you reconcile something like that?
When value stocks or areas that we think of as defensive, like what you're talking about, when they start trading at growth multiples, you run for the hills and you sell, right? Now, it's the same thing the last guess on Walmart. Take Walmart, take Amazon. Amazon's trading at half the multiple and twice the growth rate. What's going on there? I'm not paying 50 times earnings on Walmart. I don't care how good it is. And so I think what people have to remember, and this is part of the money game that people forget, there's no permanent value stock. A company, a CEO doesn't say, I want to grow up and be a value stock so Lee can buy me.
Right.
You realize your shareholders say, you're a value stock right now, and either you turn the ship around, you get the multiple up and re-rate it, or we'll find somebody else that does. And so the power of value is in the churn. And I understand ETFs. Listen, I love ETFs. They make my job easy. I can diversify, I can put things together, but it is true. Just because something says it's a value screen doesn't mean it's a good deal. And you have to move things around to find where the value is. And that got lost in our ETF sort of obsessed world.
Yeah.
And I think that by the end of this year, you're going to have some, I'm not sure it's here yet. I'm not sure I want to buy Adobe yet. I've had a few times. I've stopped out, taken a break. But eventually we're going to get to this moment where a lot of great companies are going to sell for cheap. Like right now, for instance, like a year ago, it was Google of the Mag 7. That was the value stock of it. Today, Google's up quite a bit in the last year.
Yeah.
I'm going to stick my neck out and say Amazon of the Mag 7. That's the value stock of today. And you can take any sector you want and find it.
You're a stock picker. Now, history shows that long-term outperformance, alpha, comes from this great mix, where you have a company with a starting point of a PE ratio between 10 and 20, trading above 30 times compounded annual growth rate, and that's where your sweet spot is with respect to outperformance. But this also feels like the Loch Ness Monster. Are there stocks or companies out there that fit this profile anymore?
There are. You have to look for them. For instance, a year ago, take a look at Caterpillar. Nice company, one of the best companies in America, not a nice company. They're doing their thing. They had some earnings issues because of the dollar, some currency fluctuations. That's all noise. But it was trading about a 20 multiple, kind of the higher end of what you're talking about, solid earnings, solid prospects. And then all of a sudden, people realized, my God, they're selling these gas turbines for the AI data centers. Things accelerate. Now it's doubled. The PE is close to 40. Was that a value stock? Hell yes, it was a value stock. Was it Loch Ness? Yes, right there. Here's the problem. Loch Ness has now become overpriced.
Right.
And so you have to be able to have the courage to take profits off or just say, I'm going to sell this. I'm going to take this filthy lucre that I've made. It's been wonderful. Now I need to find the next Caterpillar. And that's why value is hard. That's why people don't like to do it, because you've always got to be searching and you're going to be embarrassed and wrong for multiple years And even when you buy value ETFs, think about the last few years. If half my equity exposure is on the value side, I look like I'm sucking wind. And over the last 12 months, all my value stuff has outperformed the Nasdaq.
Yeah.
Last 6 months,
You're
last 3 months, year to date, I'm killing it. So even though I love value, it's where I live. It's how my father raised me. Read Warren Buffett's annual reports or you will not get an allowance. But I also have to tell my clients, we can't just live on value alone. We have to have a little bit of growth there as well. And right now, let me tell you, the Nasdaq 100, of all the things I could say, is starting to look good. Because if we could have this thing closer to a 20 forward multiple versus a 25 where it is today, I'm in. I'll come back on the show and tell you I am knee deep backing up the truck on the Nasdaq.
I want to share, because we're going a little extended here, some other ideas. I know you like ExxonMobil, Johnson & Johnson, and you laid out a great case for Amazon. Lee, your father taught you well, my friend. Talk to you again real soon.
Thank you.
All right, see ya.